Hello everyone, welcome back for another YouTube video. Today is the 6th of August 2024 and I'm hoping everybody survived yesterday's price action in the markets, and we've done a lot of looking into over the past 48 hours of what happens, and ultimately we're going to continue to do so. So we usually don't do kind of 2 daily market updates. However, given the nature of what's currently playing out in the markets, I think it's important to really focus on that kind of macroeconomic environment, what's currently taking place, and keeping everyone up to date on it, because there's obviously a lot of panic that has been derived from yesterday's price action. And just to kind of pull something up that I found rather interesting, this is an article from CNBC. Now, yesterday we had the worst single day in the Nikkei's history. Today, we've had the best single day since 2008, and it's amazing how things can very much change in regards to sentiment. There was fundamental undertakings that caused turmoil in the markets yesterday. We had a kind of weakening effect on the markets, or a readjustment, obviously based on non-farm payroll and the unemployment rate, which is showing a weakening from an economic data point of view. It is just one data point of view, but a big one to watch. The correlation is unemployment goes up, markets typically go down, unemployment at a high, markets at a low, and vice versa. So you had that as a kind of weakening blow, if you will. And then, of course, we've had the unwinding on the back end of yen strength, because with the Japanese yen having a 0% interest rate, people have borrowed yen and they've put it into things with potentially, for example, the dollar with a higher interest rate, a higher return, or they borrowed it into dollars or other currencies and then put it into the stock market so that they can get a kind of yield off of essentially what has been free money. And as you've seen that yen get strengthened, big moves against the Dixie, which is kind of a double-edged sword. So we want the Dixie to come down. We think when the dollar's kind of strong, that's generally kind of tight conditions for markets, and when it comes down, it's going to see risk do well. That's still in play, but certainly the factor that caused things was the yen kind of gaining strength has sort of caused an unwinding of what is called a carry trade, so the carrying over of the yen at zero interest rates over to other markets to hunt for a yield. So we've covered that. We're going to be looking at the sort of markets objectively. We're getting a bit of a recovery today. We'll be taking a look at Bitcoin. We're also going to talk about Bitcoin in regards to the 4-year cycle theory, the kind of period that we're in, not only from a seasonality point of view, but also from a sort of 4-year cycle theory, obviously post-halving. We'll then be looking at and kind of reiterating the fact that we think everything is actually doing quite well. In fact, before we do that, we're going to be playing 2 clips. So clip number 1 has came out at the time of recording in the last hour, and it's from Kamal C. Kumar. And he's essentially talking, obviously, about what's taking place and more broadly the state of the economy. Now, we've got a lot of criticism for coming out, even despite yesterday's event, and saying what you're seeing isn't people pricing in a definitive recession. What you're seeing is the increased probabilities of recession, so people hedge that, which doesn't mean we're in a recession. I don't think we are. And on top of that, you're seeing an unwinding of the yen carry trade. And that's compounded and caused volatility in the markets, which has largely been handled. The VIX had, I think, the highest spike since 2008, and it was getting up to the sort of March 2020 levels. It wasn't quite as high. I don't know if the VIX has a ceiling, but when you see that VIX spike, markets go the other way. When you look at markets more broadly also, I saw lots of words, and we warned people about this in regards to yesterday. People talking about black swans, people talking about crashes, so on and so forth. And okay, Nikkei certainly crashed. Crypto, if it was the stock market and we didn't know that volatility was inherent and crypto was a high beta, you could say maybe that had a crash. Generally, markets are actually okay. There's likely going to be, I think, a little bit of turmoil on the back end of this. I think we've seen some buying come in, but it's not been as strong as perhaps I'd have liked to. So there might be, if you think about the unwinding that's taken place, there might be more of that to come, certainly on the back end of strength. So people are adjusting their Nikkei position based on the yen strength, sort of paying off those positions, certainly the ones that weren't margin called. They're ultimately, there might be a little bit more of that, and they might take advantage of this strength and sort of sell into it a little bit. So it's likely going to cause a bit of a chop. I'm not sure the pullback's going to be immediately engulfed, but I do think eventually it will be engulfed. So I'll be looking from a clip of Kamal and also Amit, or Joe Amit. These are both from CNBC. Good takes on the sort of economy generally, and of course what took place yesterday, and kind of simplifying it all down. Then we'll be talking about the economy generally. We just had news that starting from tomorrow, so it's the 6th of August 2024 today, the Treasury will begin to buy back up to $46 billion worth of bond. They're going to be getting that from the reverse repo. That's running out very quickly. The Fed, we know, are going to lower interest rates. They're also likely going to step back into the markets. And that's going to align with global liquidity cycles, PMI cycles. We still think we're in very good standing and there's an amazing opportunity ahead. And actually, sometimes the markets need to go down before they go up. We've been in this kind of pullback, boring-ish period, and then there's this sharp drop, kind of washes out the kind of, or wakes people up, and then there's a resurgence of what is a broader trend. So we'll be talking about all that, also touching on a comment in regards to money market funds, and with interest rates coming down, that cash is going to need to then be put to work. Let's kick things off, though, with a Bitcoin chart. And when we put this into perspective, which is what we always like to do, so we use a log chart for this reason entirely, because it kind of quietens down the chart. There isn't really any cause for concern, in my opinion, in this chart. Yes, this was an extremely brutal week, or this is a 2-week period. Let's get it down to the weekly period. But this week's sort of price action has largely been bought up, and I ultimately believe that this is a pullback in a broader uptrend. When you see pullbacks in an uptrend, they're descending, not ascending. So ascending is here, descending are these pullbacks that we've seen thus far. And this is very much a big one, all happening, interestingly, and we'll talk about the halvening and sort of where we are in and around the time of the halvening, also where you'd expect Bitcoin to pull back around all-time highs, a very key level of significance. People looking at cup and handle and things like that on the back end of that. Potentially, remember, we've got that head and shoulders target to 151k. We go with the targets that we have until they've been invalidated. Targets will, on smaller altcoins, get invalidated along the way. That's how it goes. But we're very bullish on Bitcoin and ultimately think that, personally, if you want what I did yesterday personally, so I loaded up on Allincrypto, a small amount. I'll probably buy a lot more crypto when I see the dust kind of settling in the next sort of coming days. The one thing that I went heavy on was a specific crypto mining stock that I think it offers over a 20x return. Miners look great. It kind of compounds the reason why we're bullish on the market as a whole. But Bitcoin really doesn't look too bad at all. It's a slightly more brutal story when you look at the altcoin market. Hedera Hashgraph, for example, is one of my favorite altcoins. This very much just back in what I believe is accumulation, or phase one, as we call it, or the bottom of the market. And ultimately, we still think that's some pretty spectacular upside to come. They haven't bounced back quite as well. And also when you talk about things like Total 2, this was severe, but, I still think very much in the realms of a pullback. That ultimately is going to lead to continuation. So are we going to just rock it? Yeah, we've seen some great price action thus far. We're going to have a little bit of angst. So I'm currently recording this. I don't think the US stock market is open. It may just have opened around the time of the stock market. There's going to be a little bit of angst. Is there going to be continued unwinding? Potentially. Dollar coming in a little bit strong today, kind of alleviating things. Interesting that actually dollar strength is, at this point, kind of not such a bad thing, because it's kind of going to give it's going to cause people not to have to sort of liquidate their positions in regards to that carry trade unwinding, and hopefully that happens in an orderly manner. And I do think things are going to happen in an orderly manner, i.e. the economy, they're going to lower interest rates. We're not going to get that recession horrific sort of data that we've looked at. If we look at the markets in regards to the halvening cycles, or halvening, whichever way you want to call it, I don't think there's a right or wrong in my opinion. You can see that typically after every halvening there is a kind of period of sort of sideways price action. It's corrections before you then continue in the direction that I believe we're now destined to go on. So this is always going to be a lame period. Also, you've got seasonality in the markets. Markets will really start to fire up towards the back end of the year. Remember, you've got this beautiful thing going on now with the Fed looking to lower interest rates, the Dixie going in the exact direction we want it to, perhaps under a slightly different context, but still following everything we've technically set out. This should alleviate and be good for risk at a time when they're going to be lowering interest rates. They're going to be, it aligns with global liquidity. So when you look at the picture of the whole, it's still a great one. Certainly Bitcoin held up very well. Altcoins got hit very hard as the kind of paper bang in the wind of the kind of macro whirlwind. But generally, we think we're in good standing. When you look at markets more broadly, gold very much marching towards the target that we had for it. Did gold crash? Did markets really crash yesterday? I don't think they did. something like Tesla. And you can see it was very kind of disorderly, but also maintained. There wasn't too much contagion in the sense that look at the gaps you got here. So this is forced sellers causing that gap on the kind of market open. Good possibility you close them up. So let's talk a little bit, or let's dive over to a couple of clips that we have for you. The first one is from Komal, who essentially is giving his view on things.
No, I don't think the Fed should have moved in July, and I don't think the Fed should move in September. So I think what happened over the past week were the developments in Japan, the first rate increase in quite a long time. Japanese interest rates have been too low, and the Japanese are the major creditors to the rest of the world. So when the interest rate went up, it made it more attractive for the Japanese to take the money back. And global investors, in turn, sold when they found out that the yen appreciated massively in reaction to higher Bank of Japan interest rates. So that's Japan. Now, coming over to the United States, I think it carried over to here because of the expectation that high valuations in tech caused a tech drop yesterday. And then you had the overall market taking fright over the possibility of a recession. Now, the other thing to touch upon, Joe, is what is happening on the recession side. An important development yesterday, momentarily, it happened for a few seconds, is that the 2 to 10 yield curve actually became positive after being inverted for 2 long years. What it says to me is, yes, the risk of a recession has increased, and that is what is also showing up in the market correction last week. The Fed should not act, Joe, because I don't think the Fed should act in response to simply the markets. That is not the mandate. The mandate is economic growth.
But the markets move because of the jobs number.
The markets moved because of the jobs number, but what was wrong with the jobs number?
I don't know, you tell me.
14,000 jobs created. Very healthy. 4.3% unemployment rate, not very high. Wages are still rising significantly. Inflation is above the Fed's target. So the Fed has 2 mandates: keep up economic growth and bring down inflation rate. Both of them are in the process of happening. Why do you need to change?
So I never really thought I'd be in a position where we'd be kind of congratulating the Fed. And I don't think I'm in that position at the moment because ultimately I think they're the cause of a lot of problems in the world. However, in regards to their mandate, bringing down inflation, we know inflation isn't really an issue anymore. We weren't in that kind of camp of the second wave of inflation resurging. Also, we think that economic sort of data has been good. Yes, okay, we're seeing weakening in certain areas, but not to the degree that you'd then start calling for a recession. The probabilities of recession have increased, that's for sure. We saw the yield curve on invert yesterday, but there's usually, if you go and look at an inversion, a period of time before a crash actually happens. And that's the camp we've always been in and continue to be in, that you've got this window of opportunity before the big one takes place, predicted by the yield curve and other things like that. So let's play clip number 2.
Quite a market over the course of the last couple of days, and clearly a violent unwind of a lot of positioning over the course of the last couple of days. We still think the underlying fundamentals of the economy are sound, although signs of weakening clearly. So I think you're going to continue to see a bit of chop as this unwind continues. It doesn't unwind in a day, right? It takes a bit of time.
So we've been talking about what that unwind looks like. Some of the unwind, by the way, happening in Japan. That seems to be a huge component, part of this. Absolutely. But are you thinking to yourself when clients call, as I'm sure they did yesterday, and say, either should I be selling or maybe more importantly, I've got some cash on the sideline, should we be buying into this market? You're telling them what?
Well, I think your point around cash is really important because we think that the Fed's going to move rapidly over the course of the next 6 months or so, right? The market right now is pricing in roughly, 120 or so basis points of reduction in the Fed funds rate. So those who have been earning 5.5% in cash are going to start to earn a lot less than that. So starting to put money to work as you see this rate cut cycle begin, you see inflation coming down. It may not necessarily get to the target level, but clearly it's come down. So I think you want to start to put money to work as we move into the next phase of the cycle.
Put money to work. That is one reason, actually. You know, when they lower interest rates, there's a number of reasons why the market's typically going to do well under that context. One of the big ones, it sort of takes the strength out of the Dixie, and then people, just like as you see the strength going into the yen, you see people moving out and going back into the yen. When you see strength moving out of the dollar, you'll see people going out of the dollars and moving back into assets. And actually, in regards to money market funds, there's a record $6.4 trillion in them. That's going to come back. This is one fundamental reason why we're bullish on the markets with interest rate rises, along with a weakening Dixie, and obviously technically what we're looking at. But money market funds, you're going to see a lot of this money when they start lowering rates and start providing less of a return. You're going to start to see a lot of that go back into the markets. A variety of markets. It'll be quite spread out, but there's a great opportunity ahead of us. And actually, what really took place yesterday was but a bump in the road in what is a broader trajectory of assets, in my opinion, doing very, very well. You know, we looked at UK housing. We're very bullish on UK housing. The amount of negative comments we got on that in regards to people disagreeing without putting forward a reason other than, nobody's looking. We looked at the charts. We looked at charts for a number of different housing sector-related stocks, assets, and also things like mortgage applications, mortgage approvals, all these things, and they're all pointing in the same direction. And people were sort of, on yesterday's video saying, I thought you said the UK housing was going to go well. Believe me, it will. Everything is going to go well in the environment that we're now about to go into, and they're going to allow people to think everything's okay before they pull the plug. Crashes don't happen when people are expecting them. So fundamentally, a lot of money to come out of the sort of money market funds and cash on the sidelines. I was listening to a great talk actually on Warren Buffett. People quote Warren Buffett and they say, okay, well, he's got now, I think it's $271 billion worth of cash. Major cash pile. This must mean he thinks something's going to happen. Well, Warren Buffett's had a lot of cash for a long time. Certainly, if you look at the rally the stock market had, he had a lot of cash throughout that whole period. And was it 2020? He had a similar amount of cash in regards to his overall portfolio that he does today. Just because he's got a higher dollar value or more of it, does if you look at it as a percentage, it's not actually as bad. A couple of interesting things that have taken place today. So this is from the Treasury. So as of tomorrow, they're going to start buying $46 billion worth of outstanding government securities. This is a form of liquidity back into the markets. The Treasury have been a massive provider and largely null and void a lot of the QT that JP has been doing because they've been pumping money into the markets through draining the reserve reverse repo. These guys are at, this is when they upped the debt ceiling, by the way, when everyone was also calling for a crash. It's currently at $316 billion. This isn't going to take long to get drained. And then the question is, well, where do they get that money from? Who steps in? And at that point, you're going to see the Fed coming down with them. And also, we know, we've looked at this, and we looked at this in today's video, things like M2 are increasing, breaking out, in fact, I would say. Things like, and this all aligns with global liquidity and the things on the sort of broader context. Things like the Fed balance sheet are increasing also. So you got SVB here. Yes, coming down slightly. But ultimately, the broader trend of this, I think, is going to start to uptick. So there's a lot going on. We will get back to our usual evening videos where we dive into projects that we're very interested in. But for now, given the kind of situation, we want to keep people as up to date on it as possible. So just bear with us, guys. We'll be back to covering your favorite altcoins tomorrow. On that note, I'm going to love and leave you. Thanks a lot for watching, ladies and gents. I'll see you all in the next one.